On September 15, 2008, Lehman Brothers, the fourth largest investment bank in the world, declared bankruptcy.
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 In the world of finance, Lehman Brothers was a name that commanded respect. For over 150 years, it was synonymous with Wall Street power, wielding influence that spanned the globe. But on September 15, 2008, the unimaginable happened. Lehman Brothers filed for bankruptcy, marking the largest bankruptcy in American history. The firm's collapse shook the foundations of global finance, triggering a financial crisis that would reverberate across economies and industries. The story of Lehman's downfall is not one of misfortune. It is a tale of unchecked ambition, extreme leverage, and a belief that power could overcome risk. The seeds of Lehman's collapse were planted long before that fateful September day, in an era when confidence overtook caution, and risk was no longer something to be feared, but something to be embraced. What happened to Lehman Brothers was not just a corporate failure, it was a systemic rupture, a reminder that no institution, no matter how powerful, is immune to the consequences of unchecked risk. This case file is based on publicly available documents, bankruptcy filings, congressional testimony, Federal Reserve transcripts, and the findings of the Financial Crisis Inquiry Commission. What follows is a deep dive into the rise and fall of Lehman Brothers, where we'll explore the role of leverage, the impact of market forces, and the ultimate collapse of a giant. Lehman Brothers was not fragile in 2006, it was dominant. By then it had become the fourth largest investment bank in the United States, with deep ties to Wall Street, access to political power, and a reputation for financial expertise. The firm had earned its place as a global player in finance, with a focus on investment banking, trading, and financial services. In 2007, Lehman Brothers reported record revenues, a testament to the success of its business model. At the helm of the company was Richard Fuld, who had been the CEO since 1994. Under Fuld's leadership, Lehman Brothers had weathered numerous financial storms and emerged stronger. The model at the time seemed infallible. Borrow short, invest long, and magnify returns through leverage. Lehman's model was built on the idea of leverage, borrowing large sums of money to increase its financial exposure and potential returns. At its peak, Lehman was leveraged roughly 30 to 1. For every dollar of equity, the firm held around $30 in assets. Leverage, in this context, was a tool that made Lehman powerful, but it also made Lehman fragile. The higher the leverage, the greater the risk. If asset values fell, Lehman's equity would disappear quickly, and that is exactly what happened. Leverage is a double-edged sword. When asset values rise, leverage allows a firm to amplify its returns. But when asset values fall, leverage can lead to catastrophic losses. The collapse of Lehman Brothers was not an isolated event, but the inevitable consequence of the firm's extreme reliance on leverage. In the years leading up to the collapse, Lehman Brothers had been building up a massive exposure to mortgage-backed securities, MBS. These securities, which were tied to the housing market, became increasingly risky as the U.S. housing market began to cool. But instead of pulling back, Lehman chose to double down on its real estate investments, further increasing its exposure to the very assets that were showing signs of distress. Internal documents revealed that Lehman's executives were aware of the risks, but chose to ignore them. Confidence replaced caution, and belief in the market's recovery overshadowed the growing concerns about the housing market. This was the critical inflection point, the moment when Lehman's leaders made the decision to commit fully to their strategy, disregarding the risks. They believed the market would recover. They believed that their leverage would carry them through. By 2006, Lehman had become deeply entangled in the U.S. housing market. The firm had significantly increased its holdings of mortgage-backed securities, which were tied to the performance of home loans. As the housing market began to cool, these securities lost value, but Lehman's response was not to cut its losses or reduce its exposure. Instead, it doubled down on real estate investments. In internal documents later reviewed during congressional investigations, it was revealed that Lehman executives were aware of the growing risks, but they remained confident that the housing market would recover. This belief became the foundation of Lehman's business strategy, and it was this belief that led to the firm's eventual collapse. Lehman's exposure to the housing market was not a decision made in isolation. It was part of a broader strategy to use leverage to generate returns. But as the housing market continued to decline, Lehman's exposure to mortgage-backed securities became a ticking time bomb. The year 2007 was a pivotal one for Lehman Brothers. The collapse of two Bear Stearns hedge funds sent shockwaves through the financial world. Credit markets tightened, and banks began to reduce their exposure to the housing market. But Lehman continued to hold on to its large real estate positions, believing that the market would eventually rebound. This belief in the market's recovery, combined with Lehman's continued use of leverage, created an illusion of safety. The firm's leaders believed that as long as they held onto their assets, they could weather any storm. But this was not the case. The market was signaling stress, and Lehman's refusal to adjust its strategy made it more vulnerable to the impending collapse. In March 2008, Bear Stearns collapsed, marking a critical moment in the financial crisis. The firm was acquired in a government-assisted deal, and the market's reaction was swift. Lehman's stock dropped, and it became clear that investors were beginning to question the firm's financial health. But Lehman survived this moment. Its executives believed that they had weathered the storm and that the worst was behind them. This belief in survival was a dangerous one. When a system survives stress, it often leads to a false sense of security. Lehman's leaders assumed that because they had survived the collapse of Bear Stearns, they would survive any future challenges. But survival in the face of crisis is often nothing more than a temporary reprieve. It is a delay, not a guarantee of future success. By June 2008, Lehman Brothers reported a quarterly loss, the first since going public. The firm's stock plummeted, and the market began to question Lehman's solvency. The Federal Reserve was closely monitoring the situation, but unlike Bear Stearns, Lehman's collateral was difficult to value. This made the firm more vulnerable to market forces. The growing concerns over Lehman's solvency were exacerbated by the firm's massive exposure to mortgage-backed securities. As the market continued to decline, Lehman's assets lost value, and the firm's ability to raise capital diminished. The market was no longer asking if Lehman would survive, but if it could remain solvent. By September 2008, Lehman's access to short-term funding had evaporated. Counterparties refused to roll over the firm's short-term loans, and without daily funding, Lehman could not continue to operate. The firm's leaders scrambled to find a buyer, and negotiations with Barclays and Bank of America began. But no deal materialized. The US government refused to intervene and offer a bailout. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. It was the largest bankruptcy in US history, and its collapse sent shockwaves through the global financial system. Pause for a moment and take a step back, because here's where it gets even more astonishing. The collapse of Lehman Brothers wasn't just the fall of a single company, it was the collapse of a crucial pillar of the global financial system. When Lehman fell, its reach was far and wide. Its failure triggered a systemic rupture that froze the global markets and brought entire economies to the brink of collapse. When Lehman Brothers filed for bankruptcy, the repercussions were immediate and catastrophic. Global markets froze. The flow of capital came to an immediate halt. Credit markets seized, banks stopped lending to each other, and liquidity dried up. The Dow Jones plummeted. The stock market lost over 500 points in one day. Money market funds broke the buck. Investors lost confidence in even the safest financial instruments. These were not isolated incidents. The shockwaves rippled throughout the entire financial ecosystem, showing just how interconnected the world's financial institutions were. The collapse of Lehman was not just a corporate failure. It was a failure of the entire financial system to handle the risks it had created. Before its collapse, Lehman Brothers seemed unstoppable. The firm's executives had earned hundreds of millions of dollars in compensation over the years, and shareholders had seen record profits. Lehman had long been considered a safe bet, and its credit ratings reflected this. For years, credit rating agencies maintained Lehman's investment-grade rating, even as the company's exposure to risky mortgage-backed securities grew. Power felt limitless at Lehman Brothers. The firm had built an empire on leverage, and the executives who led it believed they were invincible. But as the firm's liquidity dried up, the truth became undeniable. Leverage is a fragile thing, and Lehman's power was based on an illusion. Liquidity in finance is often called the truth serum of markets. When liquidity dries up, the truth about a firm's financial health is revealed. Lehman Brothers failed this test. When the firm could no longer meet its short-term funding obligations, it had no recourse. The company collapsed, and with it, the illusion of its unlimited power. The collapse of Lehman Brothers was not sudden. It didn't happen overnight. Rather, it was the result of a structural breakdown that had been years in the making. Lehman's model of high leverage and exposure to risky real estate assets was a disaster waiting to happen. Here's a breakdown of how this happened. Leverage outpaced risk buffers. Lehman's reliance on borrowing became unsustainable. As the firm increased its leverage, it failed to build sufficient risk buffers to protect against downturns. Exposure to housing deepened. Despite growing signs of trouble in the housing market, Lehman doubled down on its real estate investments, increasing its vulnerability. Dependency on short-term funding. The firm's business model depended on the continuous rollover of short-term loans. But when funding dried up, Lehman had no way to meet its obligations. Market confidence evaporated. As the market began to doubt Lehman's solvency, the firm found itself unable to raise the capital it needed. No one wanted to invest in a company whose balance sheet was loaded with toxic assets. Government support did not materialize. Unlike Bear Stearns, Lehman received no government bailout. The US government chose not to intervene, and as a result, Lehman's collapse was not just a private failure, it became a public crisis. The breakdown was gradual, the warning signs were there, but Lehman's leaders chose to ignore them. They believed in the myth of too big to fail, a false belief that size alone could provide protection from market forces. But the larger the firm, the smaller the margin for error when it comes to high leverage. The collapse of Lehman Brothers didn't happen because it was too small. It happened because it was too large and too exposed. The firm's massive size and its reliance on leverage created a system that could not withstand a shift in market conditions. As Lehman's stock price plummeted and its financial position deteriorated, the firm faced a liquidity crisis. No one was willing to lend to Lehman, and the firm's assets were no longer worth enough to cover its liabilities. In the end, it was the combination of size and leverage that led to Lehman's downfall. The collapse of Lehman Brothers sent shockwaves through the global economy. Financial markets froze and credit markets seized. Banks were unwilling to lend to one another, and the global economy ground to a halt. The failure of Lehman Brothers exposed the systemic risks that had been building in the financial system for years. As a result, the financial crisis of 2008 escalated into a global recession, one of the worst economic downturns in history. It took years for the world economy to recover, and the fallout from the collapse of Lehman Brothers continues to be felt today. Lehman Brothers did not collapse because it was small. It collapsed because it was large and exposed. The bigger the balance sheet, the thinner the margin for error. In a world of extreme leverage, a large balance sheet creates a false sense of security. Power often dies when it believes scale equals safety, but it doesn't. Lehman's collapse was a warning to the entire financial world. It proved that no institution, no matter how large, is too big to fail, and it demonstrated that leverage, when unchecked, can turn even the most powerful institutions into fragile entities, susceptible to collapse at the slightest shift in market conditions. Close Lehman Brothers had unlimited power, and yet it lost everything. The firm's reliance on leverage and its failure to heed the warning signs led to its downfall. In the end, it was not the size of the company that mattered, but its ability to manage risk. Lehman's story is a cautionary tale reminder that in the world of finance, leverage does not forgive illusion. Thank you for watching. If you want more documented power autopsies, please like, share, and subscribe, because the next collapse will look just as stable until it isn't.